Street Week with Louis Rukeyser is made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you. By the travelers, nearly 40 million Americans benefit from our insurance, investment services, and managed health care. The travelers. By MFS. MFS, helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities. We believe the most important thing we earn is your trust. Prudential Securities. Produced Friday, March 19. Our panelists are Louis Holland, Carter Randall, and Robert Stovall. Tonight's special guest is Lloyd Bentsen, Secretary, Department of the Treasury.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when the symbol of the American economy was a man named Jose Ignacio Lopez, the auto executive who couldn't make up his mind. In a weekend of wonderment remarkable even by Detroit standards, Lopez formally changed his mind not once but twice in 48 hours about whether to leave General Motors and go to work for Volkswagen in Germany. As of the time we went on the air tonight, the Spanish executive had decided to head back to Europe. But you never know with this guy, and if he should change his mind again any time within the next 30 minutes, we will certainly let you know. Lopez's highly public flip-flop and flip again ought to put to rest forever the canard that it's women who can't make up their minds. But beyond that, his memorable indecision made the perfect metaphor for an economy whose own future course seemed subject to hourly revision. On balance, the recovery remained intact, but with spectacular fits and starts that were starting to give everyone fits. The cruel winter weather held housing starts in check, for example, but more worrisome to some was the nagging loss of confidence suggested by the second straight monthly fall in building permits, which are the key to such construction later in the year. Similarly, while the average American has, in fact, been spending at an impressive rate for some time now, indeed, February was the 9th straight month of rising retail sales, consumer confidence, again the key to future behavior, was reported to be fitful and slipping. And while the underlying unemployment situation was improving to an extent that should have signaled much more hiring at last, new claims for unemployment benefits fell again, for example, and factory workers are now putting in the most overtime ever recorded since the government began keeping overtime records 4 decades ago. The business confidence that would lead to major new job creation seemed painfully absent. What was producing this national indecision, this mixing of obvious economic improvement with concern at nearly all levels of the economy that it wasn't likely to last? Was it just the normal growing pains after a historically slow recovery from recession? Or was it the beginnings of a national vote of no confidence in the bold new economic program coming from President Clinton? In Washington, at least, that indecision was notably absent. The president's budget plan was whooped through the House of Representatives in a party-line vote so awesomely complete that this was the week in which there were, bizarrely, more congressional checks on the president of the country in Russia than there were in America. Stay tuned for how long that will last. But despite the polls that show the customary early approbation of any president's economic efforts, there was unmistakable concern in the objective behavior of American consumers and businesses alike. Is that concern justified? Here to present a view from the top of the Clinton administration's economic plans for America is an old friend of this program, Secretary of the Treasury, Lloyd Bentsen. But first, let's visit the area that has always been a national leader in the indecision sweepstakes and see what actually did happen in Wall Street in the week just passed. The Dow Jones Industrial Average, full of old-line, economically sensitive companies, was saying, "What, me worry?" But this was one of those weeks when the financial generals charged forward, but the troops were notably loath to follow. The Dow scored its 4th straight weekly gain, up nearly 44 points to 3471.58, less than 7 points away from another record. But the broader blue-chip indexes were barely changed. And while the resource-heavy Amex moved to new highs, helped by whiffs of commodity inflation, the over-the-counter composite took a stiff setback, none of which budged even a single one of our 10 chief elves, the technicians who each week forecast the Dow's next 6 months and who have been at a bullish +4 for the past 5 weeks. A blip in the inflation numbers briefly unnerved the bond market, but those ghouls cheered up as the conviction grew that economic growth was slowing both at home and abroad, and that even the Germans were having to cut interest rates. With bonds thus ending the week with still further gains, the flint-hearted bond market and the so-called populist president from Arkansas continued to be the year's oddest couple, with the truly weird menage a trois completed by, of all people, Wall Street stockbrokers, who gloried in a record 11 straight weeks of billion-share trading on the New York Stock Exchange. For them, at least, the stimulus package is working just fine. Carter Randall, do these signs of possibly faltering confidence among consumers and businesses worry you at all?
Of course they worry me, Lou, and we could see confidence ebbing, particularly if that inflation figure continues in the months ahead, which incidentally I believe it might, because I think we're going to see some price increases to offset other higher costs of doing business.
Well, let's stay with that a little bit. The Commodity Research Bureau report on commodity prices did bump upward, but other people say that with money growth so slow that we're not liable to have much inflation. Why are you concerned there?
Well, there's talk about raising the minimum wage, which will push the cost of labor up, for one thing. More regulation of business, higher taxes on business. Those things are going to be passed on to the consumer in price increases, in my opinion.
Is inflation your biggest worry right now?
Longer term it is. I don't think it'll come back with a vengeance anytime soon. There's an interesting thing that comes up this time of year every time, and that is April 15th. Is tax pay day, but it's also the elimination of pension contribution day, and money might not come into the market.
Bob Stovall, Carter sounds a mite cautious. Do you share that caution?
Well, Carter touched on what could very well happen this year if the Congress passes and the President signs a bill to increase taxes, corporate and individual, this year, with the spending cuts to come all through 1997. If the corporate rate goes up this year, I expect corporations will take mega write-offs and let the taxpayers and the government share in their losses or their write-offs or their scale-backs, which could negatively impair corporate earnings. And this market's been driven by inflation and interest rates moving in the right direction and the hope that earnings would come through in a big way.
Is there any doubt in your mind that they're going to raise taxes this year?
I think they'll raise them. I just don't know when they're going to kick in, whether it's going to be retroactive or mid-year or next year. I don't think we know that yet, but that's something we have to cope with.
Are you turning bearish on the market?
Not yet. Usually the Democrat first years of the post-war period has shown a market rise of about 10%, and we're up about 5% now. We could go over 3,700, I think.
I didn't know the market was so partisan. Lou Holland, what do you make of what's going on?
Well, I think the bull market continues. I think shorter term we might have to worry about first quarter earnings, but I think that we've got an environment here where the consumer holds about $3 trillion of short-term investments that are yielding less than 3%. And about 10% of the U.S. Treasury bonds are in excess of 20 years. So I think that there's going to be money moving out on the long end of the bond curve, and obviously some of that money, I think, is going to continue to move into stocks. So I think longer term, I think the market probably will move higher.
You say the crummy returns on money market mutual funds are more important than all the politicians in Washington.
I think so.
in terms of the stock market. Do you see any new area that people should be thinking about in terms of investment?
Well, I like basically the property and casualty companies. AIG is a company that's a great growth company that's been beat up. Maybe, in fact, they'll finally get some price increases. I like some of the leisure companies, Carnival Cruise and Circus Circus. So I think there are a number of things that you can buy that aren't overpriced at this point.
None of them are guaranteed by the management. But now with a reminder that just as soon as we go off the air tonight, it's going to be time for you to make terrific investment by phoning in what I hope will be an enthusiastic and generous new pledge to your local public television station. Let's go right over and meet tonight's special guest, Secretary of the Treasury, Lloyd Bentsen. Pleasure to have you back with us.
Good to be back, Lou. Nice to see you.
Lloyd Bentsen brings to the Clinton administration not only the seasoned voice of a 22-year United States Senator, including service since 1987 as chairman of the Senate Finance Committee, but of a highly successful former businessman and financial executive in Houston. Secretary Bentsen, who was his party's candidate for vice president in 1988, is tonight making his 5th appearance as my guest on this program. Lloyd, over the years, you have been a strong voice for increasing private savings and investment in America. In your first appearance here in 1974, you favored a much lower capital gains tax rate. More recently, you've been an outspoken supporter of universal and liberalized IRAs. I don't see any of that in the Clinton program. Are we going to see it?
Well, now, you do see a great amount of saving, and you can have savings either in the public sector by cutting the deficit, or you can have it in the private sector. And we've chosen this time to do it by cutting back on the deficit. On the other side, on the capital gains for smaller companies, we're talking about a very substantial cut in the capital gain. And after 5 years holding it, you're looking at a 50% exclusion. So on a 28% rate, you're talking about getting down to a 14% rate.
You understand markets. Has the government ever demonstrated the competence to decide where investment should be made, or isn't it better off being a little neutral in that area?
Well, in that instance, I think that you can use incentives to some degree, and I think they can be helpful. I have felt that, for example, on the IRA, and I hope we get back to that IRA before too long. So,
is it going to happen this year?
No, I don't think so this year. But I think we're going to make a very material program to put in to cut that deficit and cut it very, very substantially.
We Americans are notorious for our short memory spans, but you and I have been around for a while. Can you recall any time when raising taxes actually reduced a deficit?
I think you're going to see this time, with what we lock in the way of this program, a very material reduction in that deficit, and I haven't seen that in a long time. And I'll tell you who reacts to it. The bond market has. They believe it. You're seeing almost 100 basis points drop in interest rates, and that is a substantial stimulus to this economy.
There's no question that the bond market has endorsed what's going on in the economy. But isn't it a bit weird for a Democratic president to be finding his chief support in the bond market?
I think it's delightful. I am just so pleased with this kind of a reduction, because I think it puts us more on a par with the Japanese and the Germans as far as interest rates. You can remember, Lou, when you saw Japanese interest rates at 1% and a few little warrants with some conversion factors, and that's what we were competing with. We have much more even footing on it at this time. This could lead toward, I think, building new plants, building new homes, and you're already seeing on the conversion of mortgages, people having some extra money in their pockets.
During the campaign, the Clinton theme was jobs, jobs, jobs. Lately, it seems to be deficit, deficit, deficit. That certainly does please the bond market, but the bond market would be happy if you never added another new job. Isn't this, in fact, going to slow job growth in the country?
No, I think because what we're doing, we're moving away from consumption. We're moving toward investment, and investment in the future, investment in people, in the way of training, and trying to do the things that have to be done in the conversion and the defense industry. Those types of things for rebuilding the infrastructure, which has been in real trouble. If you look at what we're doing on the infrastructure and what the Japanese are doing on the infrastructure, they're putting far more percentage-wise into the modernization of their infrastructure, and that'll create jobs, that'll help.
Texans are famous for favoring plain talk. Wouldn't it have been more honest to call the surtax a new income tax bracket?
Well, it's a tax increase, either way you count it.
But by my count, which is arguable, I take it up to the mid-40s for the top rate. If you add in all the disallowances of deductions and the unlimited Medicare tax that is now being discussed, the top rate was 28% as recently as 1990. Is it really wise to send taxes that high so fast?
No, I can recall when the tax rate was 70%, and you can too. And I can also recall that Reagan came in offering a 35% tax, not a 28% tax. And what you saw was the Congress get into a bidding competition between Republicans and Democrats and driving it down to 28%.
I also recall that in 1986, when the rates were brought down, that a vast number of deductions were eliminated that have not been restored, so that the effective rate has gone up quite high.
Well, of course, what you're trying to do is avoid the shelters, and I think we should continue to try to do that.
Are you afraid at all that by raising the top rate this sharply, you will encourage the shelters? You certainly have increased the differential between the capital gains rate and the income tax rate.
Well, let's look at that one for just a minute. If you're talking about differential today, as compared to what it was before, when it was 70 and got down finally to as low as 28, You had an enormous differential at that point. Nothing like that today. His argument, as always is, over precisely what the balance is between spending and taxing, but a large part of this program this year is tax increases. Are we going to see new, yet unannounced spending cuts? I think you'll see some more, but what you're seeing is an enormous reception to the cuts. You're seeing us talking now about over $500 billion in cuts and in that deficit, and that is material. You're saying by 97 that you'll have reduced this thing down to about a $200 billion deficit. If we just stayed with the status quo, by the year 2000, you'd be up to $600 billion in deficits. We're looking at our interest rate now as 14% of the budget, and it'd go on up to 20%, and that's just not sustainable.
If the Clinton administration is serious about reducing spending, why doesn't it implement the Grace Commission report?
Well, you've had several commissions, and what we're talking about now is cutting back the White House by 25%. In my own department, the Treasury Department, we'll have to cut it back by some 14% over the 4 years. Those are targets that are in place. We're talking about a reduction of 100,000 government employees. Those are positive numbers, and we're well underway to get it accomplished.
Are there no other major spending cuts that you would favor?
No, we've put a lot of them in, and we're ready to listen to what the Congress has on additional cuts. We've had over 150 specific cuts that we're talking about. We've seen in the past where they'd send a black box over to the Congress and say, now, these are the options. You choose them. We won't.
I was talking earlier about indecision about the future of the economy. It's critical to the success of this administration and this country that the economy grow. What is your forecast for the next year or two?
Oh, I think you're going to see something on the order of 3% in that kind of growth. Whereas you're looking at Germany with a negative growth, and you're looking at Europe with practically no growth at all, and that has to be of great concern to us. And as I was meeting with the G7 in London earlier this month, we were talking about that we, in the United States, cannot be the engine of growth just by ourselves, because we have to have markets for our products too, and that we want to work together with the G7 countries to stimulate their economies and get that growth going and the creation of jobs.
Let me turn you over to our own international observers, starting with Carter Randall.
Thank you, Lloyd. Public works spending, rebuilding the infrastructure to create jobs. This always has been a problem as far as handling the pork barrel problem in Congress. The two presidents before Mr. Clinton have both asked for a line item veto. So has Mr. Clinton. Will he get it?
I think he will. I think what you're going to see is a modified line item veto, and I think it'll work. And it'll bring about some balance where the chief executive has a better shot at cutting out specific projects. But they'll go back to the Congress vote. It'll be high profile, where you can demand a vote on those things separately, and that will make some headway.
That's certainly encouraging. A lot of our viewers are in the will writing and the trust establishing phase of their lives, and they're concerned about any cut in what might be passed on free of additional taxes in terms of inheritance. That's been discussed in the government about reducing that privilege. Can you comment on that?
Oh, I don't think seriously, not in this administration. You have a $600,000 exclusion. I assume that's what you're referring to.
Yes.
I have seen no attempt, not even a serious suggestion to cut that. I've read the rumors in the paper, but I have not seen it. And as Secretary of the Treasury, I certainly would be apprised of it.
Good.
The bond market wobbled here recently in relationship to inflation scares and also the turmoil in the Soviet Union. Well, in order to meet your budget deficit objectives, military spending is a major portion of those cuts. So if, in fact, we have to escalate or de-escalate our military spending, what alternatives? Are you going to go into entitlements to meet those 1997 objectives?
Well, you see, we've already gone into entitlements, and that's supposed to be the third rail in politics, that you don't touch it. But what this administration has done, they have said everyone has to make their contribution, and we're working to bring that one about. No one can anticipate what's going to happen in Russia, and we well understand that. And part of the deficit cutting, as you have stated, is a reduction in the defense effort. we do not have, we're the only superpower in the world that's left. We do not have another one in competition with us.
Lloyd, you said that if there had been a proposal to reduce the exclusion on estates from 600,000 to 200,000 as Secretary of the Treasury, you would have been apprised of it. As Secretary of the Treasury, would you be opposed to it?
Yes, I would. I think you have small businesses, you have farms, you have ranches. I have supported that 600,000 exclusion in the past. I continue to support it.
What can you tell us now about the likely energy and health care tax increases that we're heading for?
Well, on the energy tax, what you're looking at is something that will help attack pollution. It will reduce our dependence on foreign oil, and it'll help us raise the kind of money that it takes to cut back on this deficit. Those things coupled together. We've done a great deal of work to see that it was regionally balanced across the country, and that it was not particularly onerous for middle-income families. For example, we're looking at when it's fully implemented over the 4 years, that for a family making $40,000 a year, it'd be $17 a month. Now, if they have a mortgage on a home that they've refinanced, they've made that back many times over with a reduction in interest rates. And the market, as we have stated, has responded to that kind of effort.
Thanks very much, Secretary of the Treasury Lloyd Bentsen. Look forward to seeing you again from time to time. The program couldn't have a better salesman. Nice to have you with us. Thanks, too, to the panel. Hope you'll be back with us again next week. Then we'll look at an industry that's right smack in the middle of this year's policy debates, the one that we just touched on, energy. My guest, Frank Nuttall, is Wall Street's top-ranked oil analyst. He'll be telling us what he thinks the impact of possible tax changes will be on the oil companies, on motorists, and on investors. So come drill with us. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you, by the Travelers, providing American business with insurance, investment services, and managed health care. The Travelers. By MFS. MFS, helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities. We believe the most important thing we earn is your trust. Prudential Securities. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
This is PBS.